Hello loves, welcome. I'm Gabby Wallace from GabbyWallace.com. So many people want to know how to analyze a real estate deal, and I'm going to show you 3 ways that I quickly analyze deals in like half a second, truly, and I'm not even a math person. I always am looking at listings that are on the MLS, and I can tell you in a split second if it's a deal that I would want more information on or not. So I'm going to share that with you so that you can also do this. Disclaimer, your real estate investment is highly personal, so I would encourage you to, before you just take my formulas and plug and play, really think about what your personal financial situation is, what your risk profile is, and what it is that you want to accomplish with real estate. So, for example, after just a couple of years of investing in cash flowing properties primarily, I was able to quit my job, actually my small business, but it was starting to feel like a job, so same. So I am here to support you because I know there's a lot of people out there who would love to either ditch the grind of going to a 9-to-5 that they don't love, maybe create more passive income, retire early, or simply do work that you love doing without worrying about how much it pays. So that's what I'm all about. If you love it, then make sure to visit GabbyWallace.com and connect with me right there. You can join my email newsletter that's free so we can stay in touch. So the first framework of the 3 that I personally use is the famous 1% rule. So you've probably heard of this. I didn't invent it, but I think it's really easy, especially for like non-math majors, because let's say a property costs $100,000, just for easy math. I want to look at market rents and make sure that I can rent it for $1,000 a month. Super easy, and yes, it's possible. However, the downside of the 1% rule is that while it's possible, it's not always probable that you're going to find a property that meets this rule that is turnkey, ready to rent. If you find a property that meets this rule, where you can see that market rent is 1% so monthly market rent is 1% of the purchase price. Generally, I would expect that it would need some work. Maybe it needs paint, maybe it needs some updated flooring, maybe there's something else, and that's okay. You just have to factor that in. So if you need to drop, let's say, $10,000 on paint and new flooring, then make sure you're paying $90,000 and not $100,000 for that property if you think it's going to rent for $1,000. Now, I would warn you to be cautious on your rent expectation. So go for long-term rents here. A lot of people have gotten caught up in the short-term rental boom, and it's great. You can make a lot of money, but I personally never base my fundamental deal analysis on short-term rentals. I always base them on long-term rental, and if I can make more money with a midterm or short-term rental, I will certainly do that, but I don't want to rely on that submarket. My second rule is, I think I kind of made this up because it just works for me where I happen to be investing in the Midwest, is if I know that market rents are at least $250 more per door. So if it's a single family, $250 more. If it's a duplex, then $500 more. Sorry, I just realized my necklace is not on right. So anyway, if I can make $500 on a duplex or $250 on a single family home, and so on, more than the mortgage, the PITI, the principal, interest, tax, and insurance, then I would look for more information. Now, I don't say then I would buy the deal. No, you always want to get more information. You need to ask questions about the condition of the property, the tenants, the leases, really explore in detail what you're getting into, the expenses, what does the owner pay versus what does the tenant pay. So there's so many questions. Let's cover those in another video, what questions to ask once you decide that you want more information on the deal. So I personally look for $250 US per door in addition to my complete mortgage payment. So whether I'm looking at a rental or a flip, I'm looking for 30% more than what I paid. So if I am able to buy the property for $70K, I just am using like really easy numbers, even though it may be difficult to find a property where you're at for $70K, you can still do it in many places. I want to know that after I purchase it and put renovations in, I'm not spending more than $70K and I can sell it for $100K. You really have to be careful about taxes, realtor commissions, and going over budget on a renovation. So I look for a minimum of 30% more than what I paid. This can also apply to rent. So let's say my mortgage is $700 a month for the principal, insurance, interest, tax. I want to make sure that I'm getting about $1,000 a month for rent. So that's a little bit more than my $250 per door example, but it works roughly. And it definitely works for flips, but I will tell you this example is a pretty lean flip. Personally, I probably wouldn't even go after a flip if I was not gonna clear confidently around $100,000, because I'm not looking at flipping single family homes that are, gonna sell for $100,000. I'm looking at flipping a fourplex that would sell for $500,000 or more. So I'm looking at purchasing that for $300,000, putting in $100,000, selling it for $500,000. So whatever gets you excited to get out of bed, then do that. I'm just sharing these 3 frameworks with you that have worked for me to be able to quickly analyze a deal. Again, this works for me in the Midwest. For the kind of properties that I'm looking at, I'm looking for cash flow primarily, but I've also gotten involved in a few flips that have been very lucrative for me, but that is not my primary strategy because I really believe in the power of a long-term hold and cash flow. So I hope that these 3 are helpful. If you have other strategies, other ways that you analyze deals, then please share them in the comments. I would love to hear from you if you have questions about what I look for in a deal, because there's certainly more than just the numbers. There is a lot more, and there's a human side to real estate that I think a lot of investors miss because they're so fixated on the numbers in the spreadsheet, but they forget that it's about the people. It's about your seller and their situation. It's about tenants. If there's tenants, are they paying their rent? Are they happy? Are they going to move out right after you buy? It's about your contractors if you're doing renovations. My contractors bring me birthday cakes. We have such a good relationship. Okay, so it's about more than the numbers. So I will leave it there. I hope that this was helpful. Mwah! And happy investing. See you next time. Bye for now.